Hello again, friends. Welcome back. Are you ready for audit planning? But before we go into audit planning, let me just very quickly pull out the phases of the audit process that we used as the starting point for our discussion. So, the last video we talked about pre engagement activities, and right about now, we are going to talk about audit planning together with risk assessment procedures. So, we are still in the risk assessment phase of the risk based audit approach. Remember, we said risk assessment, risk response, and then conclusion and reporting. So, after we are able to complete our discussion on audit planning and a segue into risk assessment procedures, then we would have already ticked off the risk assessment phase of the risk based audit approach. Now, audit planning is required by our auditing standards, and there are benefits attributed to audit planning. We categorize this as the primary benefits and the secondary benefits. Primary benefits would involve helping ensure that appropriate attention is devoted to important areas of the audit, especially now where we have embraced a risk based audit approach, where we said we will focus our attention, resources, and energies on important areas of the audit. So, planning could help us do that. It would also help ensure that potential problems, especially those problems which are attached to high risk areas, are identified and resolved on a timely basis. And audit planning also helps ensure that the audit engagement is properly organized and managed in order to be performed in an effective and efficient manner. We may remember the primary benefits of planning by the mnemonic PI. P for potential problems, I for important areas, and E for effective and efficient audit. Added to that, we also have secondary benefits to planning, which would include assistance or to assist in proper assignment of work to engagement team members. Say, for example, you have identified a high risk area, and so therefore you may want to assign a more seasoned auditor in that particular area. It would also help facilitate the direction, supervision, and review of the work of the engagement team. This is where you instruct, you journey together with them, and then you review the work that they have done. Audit planning would help ensure that that is done efficiently. And it also assists in coordination of work done by auditors of components. Do you remember the auditors of the branches or the subsidiaries or the divisions? Even, for example, working with other accountants like internal auditors and even experts. So, planning would help assist in that. And perhaps we can remember the secondary benefits of planning by the mnemonic ADC. Not ABC, but ADC: assignment, direction, supervision, review, and coordination. All right, so those are the benefits of planning. Now, there are six steps, or not steps, but there are six activities that will be performed in audit planning. But since we said that we will try to limit our videos to 25 to 30 minutes each, I have a feeling that for this video, let's target up to materiality. So that's knowledge of the business, preliminary analytics, materiality, and then the rest we will talk about in the next video. All right, so let's go ahead to talk about knowledge of the business. Knowledge of the business is a requirement that is embodied in PSA 315. By the way, PSA 315 already has a 2019 revision. So I am cordially inviting you to pay PSA 315 2019 revision a visit if you haven't done so yet. Now, PSA 315 states that the auditor should obtain a knowledge of the business sufficient to enable the auditor to identify and understand the events, transactions, and practices that may have a significant effect on the financial statements or on the examination or the audit report. Now, just imagine walking into or going into a relationship. Wouldn't you want to get to know that person first? Similar to an audit, I would like to call PSA 315 as the standards on GTKY, getting to know you. So, our audit standards also require us to get to know our client. And this process of getting to know our client is what we call obtaining a knowledge of the business. Now, perhaps you might want to ask, how do we obtain the knowledge? No? So, for example, if you were on the GTKY phase, how would you obtain the knowledge? Well, you can obtain the knowledge from previous experience with the entity and its industry. If you ever had the opportunity or the chance to have worked with that entity before, or may not necessarily be the same entity, but in the industry in which it operates. You could also obtain the knowledge from discussions with people within the entity or internal audit personnel if the client has an internal audit department, other auditors, and with legal and other advisors or knowledgeable people outside the entity. Take note, at this point, we're obtaining the knowledge of the business. In the previous video, we talked about determining or evaluating the integrity of management. This one is different because we're going to obtain knowledge of the business. You may also obtain the knowledge from publications, legislations, regulations, when you read, for example, industry newsletters and such, or visits to the entity's premises and plant facilities. This might be one activity you would enjoy doing, when you do an ocular visit of the premises and the plant facilities. And whatever documents produced by the entity will also help you obtain knowledge of the entity. This will give you an idea as to what their major transactions are, who their major customers are, what their major operations revolve around in. So that is how you obtain the knowledge. Now, assuming you have already obtained the knowledge, of course, we have to use that knowledge. Now, using that knowledge would involve establishing and evaluating materiality judgments, which is part of our discussion in this segment. So, knowledge about the business will help us establish what is the appropriate materiality level. Considering the appropriateness and the selection and application of accounting policies and the adequacy of FS disclosures, we recall that the one responsible for selection and application of accounting policies and the disclosures in the FS is still management. But as auditors, we come in to consider whether they are appropriate. Identifying areas of special audit consideration, such as, for example, do they have specialized inventories? Can you imagine if your client's inventories are precious gems and stones? Of course, that would be beyond our expertise as CPAs, right? So you will identify areas of special audit consideration. And this will also help you develop expectations for use in analytical procedures, such as information or knowledge as to whether how the industry is doing. Are they somehow presenting, or is the industry in general somehow presenting a rosy picture of what will happen in the next few years? Or are we seeing a downturn of events in that said industry? So this will help you develop estimates or expectations rather later on when we talk about analytical procedures. This could also help you design and perform further audit procedures to reduce audit risk, more on that later, and to evaluate the sufficiency and appropriateness of the audit evidence obtained. Needless to say, it is really necessary for the auditor to do a GTKY with the client. Now, we are also not only tasked, it is we are not only required to obtain a knowledge of the business and its industry, but more importantly, also to obtain an understanding of the accounting and internal control system. Precisely the reason why we will be having a separate module dedicated solely to internal control considerations. But it is part of the GTKY. Understand the entity, understand its industry, and understand its accounting and internal control systems. If we're going to arrange it, so the broadest will of course be the industry, then the entity or the business, and then its internal control system, accounting and internal control system. So in this case, how will you obtain it? Okay, how will you obtain understanding of the accounting and internal control system? We mainly obtain it by the big three. I call this the big three: inquire, inspect, observe. And later on, you'll get to understand why I call this the big three, because they are present in whatever category of procedures the auditor will perform. But in this case, you perform GTKY, you understand the entity, the accounting and internal control system of the entity by these big three: inquire, inspect, observe. Inquiries of appropriate management, supervisory or other personnel within various organizational levels, inspection of documents and records, and of course, observation of the entity's activities and operations. Now, what do you need to understand? Take note, we are becoming more specific here. We are really embracing going into the accounting and internal control system. Therefore, we need to understand what are the major classes of transactions. How are these transactions initiated? In other words, what is the starting point of these transactions? When there is a purchase made, for example, what's the starting document or what's the starting activity? Do they have a purchase requisition, or do they merely call up to make the requests? So what are significant accounting records supporting documents and accounts? What are their subsidiary ledgers that they are using? What are the special journals that they are using? What is the accounting and financial reporting process? Then the evaluation of their internal controls. And we have to remember at this point, when we are still doing the GTKY, when we evaluate the internal controls, we're mainly looking at two things: design and implementation of the controls. And then what are the type of internal controls involved? Okay, but do not worry, internal controls will have its own time to shine when we talk about it in a separate module. So essentially that is about knowledge of the business. Next, we need to talk about preliminary analytical procedures. If you're one who is so fond of like comparing last year's figures versus this year's figures, or flexing your knowledge on how to compute for the ratios and how you're able to memorize the formula for the ratios. No, so this might be the activity for you. So preliminary analytical procedures is anchored on analytical procedures as a whole. When we talk about analytical procedures, they consist of evaluations of financial information made by a study of plausible relationships among both financial and non-financial data. The idea being that we perform analytical procedures because we expect relationships to be present in the financial statements. And I think you will agree with me on this. We do expect that there are relationships in the accounts in the financial statements. Why? Well, we start by an appreciation of the double entry system of accounting, right? There is no one standalone accounting entry. There are always at least two accounts which are affected. So because of that, we expect relationships to be present, and we expect that we will be able to predict those relationships, or that they exist in a predictable pattern of sorts. Now, analytical procedures are so widely used in the audit that it can be performed in all three phases of the audit. What do I mean by that? It can be performed in the planning phase, it can be performed in the testing phase, and it can be performed in the completion phase. Now, whenever you encounter multiple choice questions about analytical procedures, you best look at which particular phase is it applied, because the purpose will depend on the phase that it is applied. For example, if you talk about analytics performed in the planning phase, so the purpose is to assist the auditor in planning the nature, timing, and extent of other auditing procedures. Since it is performed at the planning phase prior to any testing, analytics performed in the planning phase is helpful for the auditor to determine if there are any red flags or unusual relationships that are seen prior to testing. Because of that, it will help the auditor respond to these red flags or these unusual relationships. Now, analytical procedures can also be performed in the testing phase. The testing phase happens in the risk response phase. So, in the testing phase, when performed as a substantive test, the purpose is to obtain evidential matter about particular assertions related to account balances or classes of transactions. So imagine in the planning phase, you just got to see the red flags, the high risk areas, the unusual relationships. In the testing phase, you get to gather evidential matter about specific assertions of balances and transactions. The third phase, where analytics may be performed, is in the overall review phase. So, as an overall review of the financial information in the final review stage of the audit, this will help the auditor determine if additional testing is still needed, if the auditor gets to see still some unusual relationships even after the testing has been done, even after evidence gathering has been performed and there still exists unusual relationships. It may be a sign for the auditor to test more. So, as an overall review of the financial information, analytics may also be done. So, you get to see they can be performed in the planning, testing, and completion phase, and they are required to be performed in both planning and completion. It is only in the testing phase that they are not required. All right, so that's analytical procedures. And now let's move on to materiality. Now, I know most of you are very interested to talk about materiality, especially since even as early as our first accounting subject, we have already heard about materiality. So this time, the focus is more on audit materiality. And we get to define this side by side with the accounting definition of materiality. So in your intermediate accounting, you must have defined materiality as information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial reports make on the basis of those reports which provide financial information about a specific reporting entity. If we go to the audit side, materiality is defined as the magnitude or an omission or misstatement, the magnitude of an omission or misstatement of accounting information that, in the judgment of a reasonable person relying on that information, would have been changed or influenced by the omission or misstatement. So, since we are already on the auditor's shoes, so our concern will be more on the misstatements, omissions, okay, or sins of omissions or sins of commission. No? So an omission or misstatement of accounting information that would affect or that would influence the decision making of the users of the information. Now there are different types of materiality, and perhaps this is one where you have encountered in your textbooks if you have already read your textbooks. But there are different types of materiality. There is what we call overall materiality, performance materiality, and then specific materiality. Now, just hang in there. We're going to try and illustrate these three different types of materiality. There are terms that we can use for these different types. When we talk about overall materiality, this may also be called planning materiality, but this is also sometimes called the general materiality level. Okay, so when we talk about overall materiality, it's the smallest aggregate amount of misstatement applicable to all financial statements. So the basis is that amount that could misstate a financial statement. Okay, the focus is financial statements. It helps determine whether the proposed adjusting entries are significant. At the end of the audit, when you are able to summarize already all of the proposed adjusting entries, and for those entries which management does not adjust, you compare it with the overall materiality. If it exceeds the overall materiality level, then that means the financial statements are materially misstated. Okay, now how to compute for the overall materiality? You find a benchmark and then you multiply that one with a percentage. We will talk about the computation later. There is also what we call performance materiality. Performance materiality is sometimes called the tolerable misstatement or the scoping materiality. This is an amount less than the overall materiality. The idea being that, well, some misstatements may be immaterial individually, but once aggregated, they may already be considered as material. So, in order to feel a little bit more confident, no, so we set an amount less than the overall materiality. And this is calculated as a certain percentage of your overall materiality in order to capture any uncorrected misstatements. Think about it as applying a haircut, okay, or a cushion to the overall materiality to arrive at a lesser amount. Now, the performance materiality is used in determining FS line items to be tested. That is why it is called a scoping materiality. Now, the auditor may also wish to come up with a specific materiality or individual materiality. Now, the specific materiality is an amount set by the auditor for particular or specific classes of transactions, account balances, or disclosures. Take note that this will only be applicable or used for the specific items that the auditor deems to need its own materiality consideration. In other words, it's kind of like those accounts which should require special attention, and because of that, they have a special, specific individual materiality. So just let's just illustrate so that we would more or less get a better feel of what are these different types of materiality. All of our illustrations, by the way, are lifted from the AASC Bulletin 001 series of 2010. So you may also want to pay that a visit. So assuming that these are the details pertinent to our client, there's total assets of 1 million. Total liabilities of 700,000, total equity of 300,000. So assets equal liabilities plus equity, sales of 800,000, cost of sales 600,000. Therefore, operating expenses of 50,000, this will give us profit before tax of 150,000. Assuming income tax provision is 45,000 and the profit for the year is 105,000. Let's start by talking about overall materiality. We recall that overall materiality can be arrived at by using a benchmark and multiply that by a percentage. As to what benchmark to use and what percentage to apply, ladies and gentlemen, it will be a matter of the auditor's professional judgment. We do have some rules of thumb, so to speak, but the standards do not prescribe a specific benchmark. It will really be up to the auditor to apply his or her professional judgment. Now, let's assume that our client is business oriented. Okay, here are some factors that may affect the choice of the benchmark. For example, the components of the financial statements or the elements of the FS. If there are certain areas that the users tend to focus more on, for example, if the users would try to evaluate or assess the performance of an entity, then they would most likely look at profit or sales, right? The nature of the entity. Is it a profit oriented entity? Is it a charitable institution? What is the ownership structure of the entity? What is the volatility of the benchmark identified? And are there any laws and regulations that need to be factored in? For example, in the case of the Securities and Exchange Commission, in its Memorandum Circular number 8 series of 2009, they consider to be significant accounts if it is equivalent to 5% of balance sheet or income statement line items if this is a listed company, mutual fund, or other issuers of securities to the public, including pre-need companies like insurance companies. However, if the corporation is neither of those, it's not listed, it's not a mutual fund, it's not a pre-need company, then the threshold shall be 10% or more. So we do get to look at requirements or provisions coming from laws and regulations. But in the case of our illustration, assume that the only thing we know is that the business is profit oriented. If it is profit oriented, you may want to use as a benchmark the profit before tax or the sales. So let's present both, okay, as an illustration. So if the auditor determines that the profit before tax is a better benchmark, then the auditor will use 150,000. But if the auditor thinks sales is a better benchmark, then may use 800,000. Based on professional judgment, the auditor will also come up with a percentage, assuming 5% of profit before tax or 1% of sales. Therefore, in this case, our overall materiality, assuming you are using profit before tax, is 7,500. If you're using sales, then the overall materiality is 8,000. That means any misstatement amounting to 7,500 and above or 8,000 and above, depending on which one you will choose, in any one of the financial statements will already render it to be materially misstated. Okay, and so therefore we might ask management to adjust so that the amount will be less than material, or if management does not adjust, then we will modify our opinion. So that is overall materiality. Again, apply. This is the amount that could misstate any one of the financial statements. Then we move on to performance materiality. Now, we said performance materiality is an amount lower than overall materiality. And so to this, we take our overall materiality and then multiply it by a percentage where we have reduced it by the haircut percentage or the cushion. Again, how do you determine the haircut or the cushion percentage? It's a matter of auditor's judgment. So, factors that may affect the choice of the percentage would be the overall engagement risk, whether you are strict or you are chill, the history of booked audit adjustments, meaning to say, how willing is the client to adjust based on your audit findings, based on, your experience with the client in the past, and if there are any fraud risks. Needless to say, the risks that we have identified will drive what particular percentage we will use as the haircut or the cushion. So assuming that performance materiality haircut or cushion is 25 or 50%. Again, this is all a matter of professional judgment. So in this case, in the previous illustration we had, the auditor was considering whether to use profit before tax or sales. Our previously computed overall materiality was 7,500 if based on profit before tax and 8,000 if based on sales. Now, if the auditor chooses a cushion that is at 25%, that means the performance materiality will be 75% of the overall materiality because we do have 100% minus the cushion or minus the haircut. So that means 100% minus 25%, that would be 75%, multiplied by 7,500. The performance materiality, if you have chosen a cushion at 25%, is 5,625. However, if you have chosen a cushion of 50%, so 100 minus 50% is 50%. So 7,500 times 50% will give you performance materiality at 3,750. Now, the same computations would hold true if the auditor used sales as a benchmark. Okay, so again, we're presenting both possibilities, whether the auditor will choose profit before tax or sales, whether the auditor will choose cushion at 25% or at 50%. But perhaps in order to better appreciate this one, let's ask ourselves, which one will you choose with the computations that we have had between the performance materiality at 25% cushion and performance materiality at 50% cushion? Which one will you choose if the engagement has a high risk? So imagine this one. You have decided to accept an engagement that had so many red flags. And because they had so many red flags and you still decided to accept it, then the auditor would then most likely choose to be more strict, right? The auditor will be stricter. Why? Because you have decided to accept a high risk client. And when the auditor becomes stricter, remember this one, which particular materiality level will you choose? Is it the higher amount of materiality or the lower amount of materiality? Which in which of these instances, higher amount or lower amount, is the auditor more strict? And if in case you need to review the concepts on this, it's found actually in our first segment, right? In our first few videos. So in this case, the lower the materiality, the stricter the auditor actually is. So the more strict you are, then you go for a bigger cushion. Okay. Now in this case, we would choose the 3,750 or the 4,000. Again, just so we would be able to recall why we are choosing this one. Imagine if your materiality level is 3,750. The moment that the misstatement reaches 3,751, then you would already say that the financial statements are materially misstated. Yes? But if you have chosen a materiality level of 5,625, even if you have seen a misstatement amounting to 5,000, you would still be okay. Why? Because you're in chill mode. Why are you in chill mode? Chill mode because the engagement is a low risk. And so even if it reaches 5,000, you're still fine. You're still okay. But had you chosen the cushion at 50%, even at 3,751, you would already be in panic mode. So therefore, the stricter the auditor is, the lower is the amount of materiality that will be chosen. True to our discussion also in the last video. So in this case, which one will you choose for a high risk engagement? The performance materiality with a lower amount. Now, we also said that there is such a thing as a specific materiality. So, to illustrate, let us assume further that the auditor has assessed that there are specific users who expect a lesser level of misstatement in management compensation. In other words, users tend to be very particular about management compensation. They tend to be quite strict with regards management compensation. Assume, therefore, that adopting a 50% threshold of performance materiality is appropriate. So to present, remember a while back we did have overall materiality 7,500. Let's just take a look at profit before tax. Okay, overall materiality 7,500. Performance materiality at 25% cushion, 5,625. At 50% cushion, 3,750. Assuming we would like to set a specific materiality for the account balance on management compensation. So our specific materiality for management compensation at a higher, okay, level would be 2,813. At a lower materiality level, 1,875. Remember again that the lower the materiality level, the stricter you become. So the 2,813 and the 1,875 is only applicable for management compensation, only special, specific, individual. So whenever the auditor examines management compensation, then the materiality level that will be used is either 2,813 or 1,875. Now, you might be a bit confused because we're presenting a lot of options here. So, just to simplify things, let us assume that as an auditor, you have determined that profit before tax is the better measure. So, because profit before tax is the better measure or criteria, so we will use an overall materiality of 7,500. Let us assume that the client is a high risk engagement. Okay, it's into a high risk engagement. And because it's a high risk engagement, then we will choose performance materiality at 3,750. And let us assume as well that there is a high risk pertaining to management compensation. And because of that, we will choose a specific materiality for management compensation amounting to 1,875. Okay, so as to what criteria or benchmark to use, what particular percentage to use, again, it is a matter of professional judgment. Okay, what is the importance of materiality? Well, it helps establish the extent of substantive tests. We have to remember the stricter we become, the lesser or the lower is the amount of materiality that we will choose. And the stricter we become, the more substantive tests we will perform. We also identify as part of the importance of materiality that it is able to evaluate potential and actual misstatements. At the end of the day, this is the amount where we compare the misstatements with. And when the misstatements would exceed this amount, then we would already say that the FS is materially misstated. And like what we have said, it defines the threshold at which the auditor would require the client to make an adjustment to the financial statements. So imagine a while back we said overall materiality is 7,500. So let's just say, for example, you were able to find likely misstatements totaling 10,000. So that means we will require the client to adjust by 2,500 so that the financial statements will not be materially misstated. If the client does not adjust, then the auditor will modify his or her opinion. So that is materiality. So I think we are exceeding a bit from our target 30 minutes, but I would say we're still okay. So we're gonna cut our discussion a little bit now. Now is the time for you to take that sheet of paper and that ball pen and to start writing down notes before you start the next video. Again, a reminder to everyone watching this video, this is now the moment where you write down notes. All right? And I'll see you in the next video to discuss the remaining three activities for audit planning.